This year's final Fed meeting is next week, and after Friday's hot jobs report, will the Fed have to raise rates by more than the market expects? Let's bring in Jason Furman, former chairman of the Council of Economic Advisors, to talk more about that. Jason, it's great to have you here. There was a little bit of an instant revisionism about the jobs number on Friday. People saying, well, maybe it was weaker than it looked on the surface. You had a shorter average work week, and maybe the wage growth wasn't as strong. But you immediately felt as if it actually did show the economy running pretty hot. Walk us through that.
Sure. First of all, I think the wage growth is the most important. That's the output of labor market tightness or labor market looseness. You had the eye-popping November number. I like to look at an annual rate, 7.8% annual rate. People were right to point out part of that had to do with quirks in hours and severance pay and the like. But here's the thing. September and October were both revised up by 1.2 percentage points at an annual rate. That's among the biggest upward revisions we've seen. And that means average hourly earnings growth trend is probably about 5.5%, which means trend inflation is probably about 4.5%. And that hasn't fallen over the course of the entire year.
So are we confident in the direct linkage between the core wage growth and how it translates into realized inflation in the coming year? Because that's going to be key to how, the Federal Reserve has to treat it.
Am I confident? No. There's obviously large error terms around anything. But if you tell me that over the next year we're going to have 5.5% wage growth, I'm going to tell you we are going to have 4.5% inflation, core inflation, plus or minus something. And the plus or minus aren't huge, and they're roughly symmetric, the errors around that.
And so where does that bring us, do you think, in terms of, because it's interesting, when we talk about how likely is a soft landing, people seem to be thinking it's either a soft landing or it's a drop into recession relatively quickly, as opposed to things just continue to run sort of hot with inflation above trend and maybe the job market remaining very strong. Where do you think it's settling out?
Look, I think there's four possibilities here. There's a soft landing. I think at best about a 10% chance of that. Really hard to bring this magnitude of inflation down without a recession. There's the hard landing that solves it. But yeah, I agree with you. I think there's two scenarios that are even more likely than either of those. One is continued overheating. The unemployment rate stays below 4.5. The inflation rate stays uncomfortably high. I think, unfortunately, the most likely scenario is we have a mild recession. It brings inflation down, but it brings it down to something like 3.5%. And so it does not solve our problem, and we need to have another go at the whole thing.
A go at the whole thing, meaning the Fed would have to retighten, I assume, from that point on.
Yeah, exactly. So I don't. Yeah. Sometimes I talk to people in markets who are like, "Oh, you have a recession, and then you get 2% inflation." No, recession means lower inflation. It doesn't mean 2% inflation. So that you might end up at the back end of a recession, maybe a mild recession with a 3.5% inflation rate, and then you have to have, a whole nother tightening cycle. So I don't think it's like rates go up, rates go down, rates stay down. We might have to deal with this more than once.
And just quickly, you think that 6% is reasonable to target as a Fed funds rate, as this unfolds?
I think it's fine for them to follow the data. I think 5.25 is the most likely. I think 6, though, is there a 25% chance of that? Absolutely.
Right. Yeah, Wall Street Journal is suggesting today that the range might get up to 5.25 next week. Jason, it's great to catch up with you. Thank you so much.
Good to see you.